Right now, somewhere up in orbit, there is a very real possibility that a satellite powered entirely by interstellar radiation is processing a transaction on a decentralized ledger.
Yeah, which is just wild to think about.
It's completely wild. Meanwhile, down here on Earth, the global macroeconomic system is violently grinding to a halt because physical shipping lanes and terrestrial energy grids are just breaking under the weight of this massive geopolitical pressure cooker.
Right. It's March 18, 2026, and things are tense.
Very tense. So, welcome to this deep dive. Our mission today isn't just to read you the market ticker, We're going to connect the dots between an escalating kinetic war in the Middle East, a completely paralyzed Federal Reserve, and how apex capital is literally escaping the physical constraints of Earth to find stability. Okay, let's unpack this.
Yeah, to really understand the financial flows you're seeing on your screen today, we have to start with the physical breakdown of global supply chains. I mean, financial markets are entirely downstream of physical reality.
Right, the real world dictates the numbers.
Exactly. And right now, the established rules of engagement in the Middle Eastern kinetic theater have essentially collapsed, which fundamentally alters how institutional capital prices global risk.
And the expansion of that conflict has been incredibly rapid. It really kicked off when the Israeli military assassinated Iranian intelligence minister Esmail Khatib via an overnight airstrike in Tehran.
And he wasn't a peripheral figure at all. He was the apex architect of their internal security.
Right. So the retaliation from Iran was this massive multi-front ballistic missile and drone offensive. And what's crucial for anyone watching the markets to understand here is that these munitions actually penetrated heavily fortified Tier 1 airspace.
Yeah, that's the part that really shook the actuarial models.
I mean, we saw cluster munitions hit a residential building in Ramat Gan, right in the commercial heart of Tel Aviv. 2 civilian deaths.
And that specific detail changes the math for literally every sovereign fund and insurance conglomerate on the planet. For years, the assumption has been that top-tier urban air defense grids like the Iron Dome, David's Sling, that they provided a nearly impenetrable shield for commercial hubs.
But they got overwhelmed.
Right. The fact that these systems can be overwhelmed by sheer volume proves that physical infrastructure in conflict zones is vastly more vulnerable than we previously modeled.
And the geography of those strikes expanded way beyond just the Levant. We're talking about projectiles crossing into the Arabian Peninsula, targeting Saudi Arabia, Bahrain, Qatar. One even struck near an Australian military base in the UAE.
Yeah, the scope is unprecedented.
But the data point that really forces the market to price in a catastrophic tail risk is the strike on the Bushehr nuclear power plant in western Iran.
Oh, wow. Yeah, that's the one.
Now, to be clear to you listening, both the IAEA and Rosatom confirm there are no radiation leaks. The core wasn't breached. Yeah, but the psychological barrier has been crossed. Suddenly, algorithms and human traders alike, they have to factor in the probability of a regional radiological disaster.
And while a radiological event is, the ultimate tail risk, the immediate macroeconomic degradation is actually stemming from the maritime geography of this conflict. I mean, the Strait of Hormuz is completely paralyzed. Nothing is moving.
Let's put some numbers to that paralysis for everyone listening. The Strait of Hormuz chokes off roughly 20 million barrels of oil per day.
That's a fifth of total global consumption, erased from the board overnight.
It's staggering. Now, if you read the headlines this morning, you might have seen a supposed fix. Iraq and Kurdistan executed this emergency diplomatic agreement to bypass the Gulf entirely.
Right, the Northern Pipeline.
Yeah, they resumed exporting crude through the Iraq-Turkey pipeline, pushing it to the Mediterranean port of Ceyhan. And Brent crude reacted a little bit to the news, settling between, $101 and $103?
Yeah, roughly 101.88 to 103.70. But if we look at the raw mathematics of that pipeline, the optimism just evaporates. The Iraq-Turkey route is moving maybe 200,000 to 250,000 barrels per day.
Right, which is it's like trying to put out a raging forest fire with a garden hose.
Exactly.
Yes, the pipeline saves the Iraqi state from immediate sovereign bankruptcy because they get some revenue flowing. But mathematically, 250,000 barrels doesn't even make a microscopic dent in a 20 million barrel daily deficit.
The market is staring at a massive structural energy vacuum. And this specific energy chokehold is the catalyst for everything happening in the broader economy right now.
Because it drives inflation.
It guarantees severe forward-looking inflationary pressures. I mean, central banks have spent the last century operating under this illusion of mechanical control that they can just adjust interest rates to fix the economy.
Like the old playbook.
But you cannot print your way out of a fractured maritime logistics route. You cannot adjust a federal funds rate to magically conjure 20 million barrels of physical crude oil out of thin air.
You just can't. Because that oil deficit immediately bleeds into the cost of absolutely everything else. It drives up agricultural fertilizer, aviation fuel, the plastics used in medical devices.
Even the diesel required to truck food to your local grocery store.
Exactly. It engineers an inflation that traditional monetary policy is structurally powerless to contain, which puts the Federal Reserve in a historically brutal position today.
Yeah, the FOMC is meeting as we speak, and they are essentially paralyzed by a stagflationary paradox. The consensus is they are forced to hold rates steady, somewhere between 3.50 and 3.75%.
Imagine you're sitting in that FOMC meeting room right now.
Yeah.
On one side of the table, you have the domestic labor market visibly softening. The February jobs report showed payrolls contracting and unemployment climbing to 4.4%.
And the traditional central banking playbook says when unemployment rises, you immediately cut interest rates. You make borrowing cheaper to stimulate business growth.
Right, but you look at the other side of the table and you're staring at that energy chokehold we just discussed. If you cut rates now, you act as a direct accelerant to the $100+ a barrel oil inflation that's already ravaging the industrial supply chain.
And the data released this morning proves exactly how hot that upstream inflation has become. The February Producer Price Index, the PPI, which measures what businesses pay for raw materials before those costs hit consumers, it completely obliterated estimates.
Headline, wholesale inflation surged 0.7% month over month.
And core PPI is sitting at a scorching 3.9% year over year. Consequently, the Fed's dot plot is expected to revise down to 0 rate cuts for the entirety of 2026.
0. Let's break down what that means for your purchasing power. When nominal interest rates are held steady around 3.5%, but real upstream inflation is accelerating closer to 4 or 5%, the real yields on traditional sovereign bonds turn negative.
Yeah, you're literally losing money.
Exactly. If you buy a government bond that pays you 3.5% a year, but the cost of living goes up by 5% in that same year, your money is shrinking. Your purchasing power is being systematically decimated by holding traditional fiat debt.
And that mathematical certainty is triggering a massive institutional capital flight. Fiduciaries are abandoning the traditional 60-40 portfolio because the bond portion is guaranteed to lose real value.
So where are they going?
We're seeing Apex Capital aggressively moving into spot Bitcoin ETFs. There have been 7 consecutive days of heavy inflows. Just today, another $199.4 million flowed into the ecosystem.
Wow.
Yeah, BlackRock's IBIT captured $139.4 million of that, and Fidelity's FBTC took in $24.4 million.
I want to play devil's advocate here for a second because this is where the narrative really diverges from historical norms.
Yeah.
If the world is on the brink of wider war, supply chains are collapsing, and inflation is surging, the traditional finance playbook says institutions should flock to cash or, I don't know, physical gold bars in a vault in Switzerland.
Right, the classic safe havens.
So why are we seeing this massive capital flight into a digital bearer asset instead? How is it decoupling from the traditional risk-off behavior we've seen for a century?
It's a crucial distinction, and it really comes down to the vulnerabilities of the physical world we just outlined. What we're observing with these massive ETF inflows isn't speculative trading anymore. It's an actuarial requirement.
Interesting. How so?
Well, institutional fiduciaries recognize that holding cash in a stagflationary environment is just financial suicide. It'll rapidly lose its purchasing power. And physical gold, while historically sound, has severe logistical vulnerabilities.
This is heavy and hard to move.
Exactly. If you need to physically move tons of gold to settle international accounts, but maritime choke points are blocked and airspace is contested, the asset essentially becomes illiquid.
So they're moving into a digital bearer asset because it strips away all of that physical friction. It offers absolute, mathematically verifiable scarcity. You know exactly how many units will ever exist, and it doesn't rely on a vulnerable physical supply chain to secure or transport it.
Precisely. It's a sanctuary against fiat debasement that can be transferred globally at the speed of light.
But to understand how this capital flight is actually playing out on the trading floor, we have to look past just the ETF inflows and zoom in on the immediate microstructural mechanics of the spot market itself. The asset is currently in a highly volatile consolidation phase.
Yeah, oscillating between 73,547 and $74,700. And as we speak, it's stabilizing near 74,267.
And that specific price action tells a fascinating story about how algorithmic trading models are interacting with human panic. What happened over the last 48 hours is that algorithms effectively hunted down and squeezed out retail and mid-tier tactical traders.
Because a lot of those human traders looked at the news, saw kinetic warfare and soaring oil prices, and assumed risk assets would inherently crash.
Right, so they tried to short the market, they borrowed the asset to sell it, hoping to buy it back cheaper, and the algorithm detected that leaning aggressively pushed the price up to liquidate those shorts, and then violently distributed the price back down.
The term for this is resetting funding rates. By violently shaking the price up and down, the market forces those over-leveraged borrowers to either pay exorbitant fees to maintain their positions or face forced liquidation.
It purges the fragile leverage from the system.
Exactly.
But here's where it gets really interesting. Despite the algorithms clearing out those shorts, on-chain models have identified a massive $4 billion liquidation cluster sitting dangerously close, right at the $69,000 threshold.
That is a huge cluster.
It is. Think of it like a massive industrial magnet hidden just beneath the floorboards of the market. If the floor cracks even a fraction of an inch, say, Jerome Powell gives a surprisingly hawkish speech this afternoon and breaks the immediate $71,000 support level. The physics of the market take over.
Right, the cascade.
Yeah. When the price hits $69,000, exchanges issue margin calls, forcefully selling off traders' collateral to cover their debts. That selling pressure drives the price even lower, triggering the next guy's margin call and the next. Everything above gets violently pulled down into the basement.
What's fascinating here is that despite that $4 billion magnetic risk sitting just below the surface, the spot market is demonstrating immense absorptive capacity. The high-frequency algorithms are actually performing a necessary function.
Like clearing out the weak hands.
Yeah, by stress testing those price levels and purging the excess leverage now, they're building a fortified, deleveraged foundation for the next leg of price discovery. And crucially, the fiduciaries buying through BlackRock and Fidelity aren't using leverage.
They're buying spot.
Exactly. They are absorbing the actual spot supply, taking it off the exchanges entirely, which effectively thickens and hardens that floorboard.
So while Apex Capital absorbs the asset to protect its purchasing power, legacy financial monopolies are aggressively moving to own the actual plumbing of this new economy. I mean, MasterCard just announced a definitive $1.8 billion acquisition of BVNK.
Yeah, the London-based stablecoin infrastructure provider.
We are talking about integrating technology that processes cryptographic payments across 130 countries directly into the legacy MasterCard network.
And the valuation of that acquisition makes perfect sense when you look at the throughput. Stablecoin volume reached $350 billion in 2025. Legacy networks like MasterCard can no longer afford to simply observe that kind of settlement efficiency.
They have to own it.
You have to capture it, yeah. They need the ability to settle international transactions instantly without relying on the cumbersome correspondent banking system.
And the regulatory environment in the U.S. has completely pivoted to accommodate this. The U.S. apparatus has formally abandoned the era of enforcement-driven hostility. They've established this comprehensive pro-innovation taxonomy that greenlights legacy giants integrating blockchain rails.
But if you look at Southeast Asia, we see a totally different approach.
Right. Vietnam is orchestrating a severe state-mandated realignment. They are actively banning citizens from accessing offshore exchanges like Binance and OKX, but at the exact same time, they are licensing domestic exchanges that are directly affiliated with their major private banks.
Like Techcombank and VP Bank.
Exactly. So you have the U.S. and MasterCard fully embracing the borderless architecture, while nations like Vietnam are trying to build heavy walls around it. Does this mean the technology has simply become too big to ban, so sovereign states are settling for trying to capture the liquidity instead?
This raises an important question about state control versus technological inevitability. What Vietnam is doing isn't anti-crypto, it's anti-capital flight.
Oh, that makes sense.
When a nation faces macroeconomic pressure, its citizens naturally look for ways to move their wealth into harder assets outside the local currency peg. Vietnam recognizes they cannot uninvent cryptographic assets. If they simply ban it, the liquidity just moves to the black market.
So their only viable defense mechanism is to capture that liquidity within state-monitored domestic silos.
Exactly. Meanwhile, the U.S. and Tier 1 payment networks view it entirely differently. They see these assets not as systemic threats to their currency, but as essential programmable architecture. It's the undeniable future of cross-border business-to-business transfers.
So both actions, whether it's MasterCard buying the plumbing or Vietnam building a walled garden, ultimately validate the underlying permanence of the network.
Yeah, that permanence, however, relies on one inescapable physical requirement: immense continuous thermodynamics.
The energy.
Right. The network requires vast amounts of energy to secure its global ledger. And this brings us full circle to the geopolitical energy crisis we started with. As sovereign nations on Earth weaponize their energy grids, and as terrestrial power becomes scarce and expensive, the infrastructure securing this digital economy is literally leaving the terrestrial grid behind to survive.
And the thermodynamic migration we're tracking right now sounds like science fiction, but it is happening today. Corporate miners are executing a massive pivot. Just look at HIVE Digital.
Yeah, their new project in Paraguay.
Exactly. They just activated their BUZZ AI cloud platform down in Asuncion. They are utilizing 300 megawatts of stranded hydroelectric, power-clean, localized energy that couldn't easily be exported to train complex, large language models for an academic research team at Columbia University.
It's brilliant.
It proves that legacy cryptographic miners can successfully pivot their high-performance computing infrastructure away from just securing the ledger and into high-margin enterprise AI hosting.
That is an impressive terrestrial pivot, for sure, capitalizing on geographical energy disparities. But the horizon for network security is moving much further out than South America.
It's moving into orbit. A startup called StarCloud, which is heavily backed by NVIDIA, just announced plans to launch application-specific integrated circuits ASICs, the hardware used to mine Bitcoin directly into space, late this year.
Literally mining in the vacuum of space.
Yeah. The economics they're claiming rely on utilizing continuous interstellar radiation, which they say provides a vastly superior power-to-cost ratio compared to any terrestrial operation. Plus, space itself is basically a giant free cooling fan for these servers.
Which solves a huge overhead cost.
Right. But I have to ask, so what does this all mean for the actual engineering of the network? I get the appeal of free solar energy, but is orbital mining actually a viable engineering reality right now, or is this just an incredibly expensive PR stunt? I mean, how do you even manage the latency of deep space data transmission for a network that relies on highly synchronized 10-minute block times?
Well, if we connect this to the bigger picture, the latency question is exactly where the engineering focus lies right now. Light speed limits and deep space data propagation delays mean an orbital node cannot participate in terrestrial block consensus in real time, the way, say, a server in Texas does.
So how does it work?
Currently, StarCloud is utilizing a batch-proof model. The orbital ASICs perform the heavy, energy-intensive hashing computations using that free interstellar radiation, and then asynchronously beam-batched cryptographic proofs down to localized terrestrial nodes for final verification and inclusion in the block.
Oh, I see. So they were essentially decoupling the raw thermodynamic work from the immediate data synchronization. They do the heavy lifting in space and just send the receipt back to Earth.
Exactly. And while it is strictly an experimental proof of concept today, the engineering viability isn't the primary takeaway here.
What is?
The takeaway is the terminal trajectory it signals. The protocol fundamentally demands continuous energy expenditure to exist. As long as the network relies on terrestrial power grids, it is vulnerable to earthly geopolitics.
To blocked maritime choke points in Hormuz, to bombed power plants, to sovereign governments simply flipping a switch.
Exactly. So the network is actively engineering a way to extract its required thermodynamics directly from the cosmos, totally bypassing terrestrial geopolitical friction.
It is the ultimate insurance policy, a complete decoupling from the physical vulnerabilities of the state. So, to recap the massive journey we've taken on this deep dive for you today, we started in the physical world, looking at kinetic strikes breaching the airspace over Tel Aviv and a paralyzed Strait of Hormuz choking off 20 million barrels of oil.
Right.
We explored how that physical supply chain collapse trapped the Federal Reserve in an inescapable stagflationary reality, forcing real yields negative and destroying the purchasing power of fiat debt.
Which triggered the institutional flight.
Exactly. We watched how that exact actuarial dynamic is driving billions of dollars of institutional capital out of traditional safe havens and into the mathematically scarce sanctuary of digital bearer assets, despite the algorithmic volatility and the multi-billion-dollar liquidation magnets lurking just beneath the trading floor.
And finally, the infrastructure evolution.
Yes, we saw the infrastructure itself mutating to survive, with legacy giants like MasterCard buying up the plumbing, while the raw thermodynamic engines escaped to Latin American hydro dams and eventually Earth's orbit.
And that thermodynamic escape leaves us with a critical paradigm-shifting concept to consider. If the ultimate decentralized ledger soon relies on satellites and interstellar radiation to secure its baseline computing power, who truly governs the rules of that network when its physical infrastructure operates in the vacuum of space, completely outside the jurisdiction, the energy grids, and the reach of any sovereign nation on Earth?
A completely frictionless sanctuary floating above a fractured planet. Thank you for joining us on this deep dive into the architecture of tomorrow. We'll be back to unpack the next layer soon.
Until next time, stay analytical.